it's a really scary scenario where we could see, in my opinion, it's very likely we'll see a protracted, like a long-term bear market that could last for 5 to 10 years.
In a recent interview, Chief Market Strategist of InTheMoneyStocks.com Gareth Soloway tells us all about his latest analysis of the charts, as well as his predictions and price targets for Bitcoin and gold. In his opinion, he still believes that Bitcoin might drop further to a low of $12,000. He is also a proponent of crypto regulation, believing that it would be a positive thing for Bitcoin and cryptocurrencies in general, as institutions would feel more confident investing their clients' money in them. Before listening to him, please ensure to smash the like button and subscribe to the channel. Let's dive into his last interview now.
So I think that's the big thing. And this was a shock to the US equity markets, is you basically got the 75 basis point hike, which everyone expected. That was not a surprise. But the statement was unbelievably hawkish, in fact, guiding the market that they're even going to continue to be aggressive into year end, basically upping where they're saying interest rates will be by year end. And that shocked the market. And this was such a wild day because that statement alone dropped the market precipitously. We saw about a 2% drop in the S&P in the matter of 20 minutes. Then Jerome Powell did his press conference. And in the press conference, he kind of was ever so slightly open to letting economic data dictate. And all of a sudden, the market just ripped higher. And we saw the markets go all the way to new highs of the day. So now we've rallied basically up 3% to the upside. Now, all of a sudden, the markets started to redigest what he's been saying. And they're like, wait a minute, we're not going this way. And the market sold off and made new lows of the day, basically dropping over 3%, ending at the lows of the day. It was a day for the ages. And I'll show you guys here what the chart looked like on an intraday basis. This is the 10-minute chart. You can see starting here, it was real quiet. So all day long, everyone was just waiting. Here's where the statement came out. And so we were up on the day. This is where we closed the previous day. So the markets were up. We sold off from 885 down to 820 on the S&P. So, I mean, that was a big drop, $65 drop or 65-point S&P drop. We then rallied all the way back above 900 to 907 and then closed down at 3789, 3790. So one of the wildest days I have seen in the equity markets in terms of whipping the markets. And again, it sets us up for just probably a pretty crazy day tomorrow where the markets are trying to really figure things out.
Can we figure things out? I mean, you said the Fed's hawkish. Where to from here?
Yeah, I mean, this is the kicker, right? And I've said this before. I think the Fed to me has always been behind the curve, whether it's when they're printing money when they really shouldn't be, or when they're tightening out of panic because of inflation in this scenario. And I really, if I could talk directly to Jerome Powell, I would say be very careful here, because now you've raised 3 times in a row, 75 basis points. You're guiding that you're probably going to raise another 50 in November at least, maybe another 25 into December. And we haven't even seen the full effects of the higher rates yet. Right? So the economy still hasn't digested all of that. And you have to be careful here, because with interest rates, rising and inflation still high, if we go into a bad recession, and let's say we go into a global recession, which it looks very possible we will, how do we get out of that recession? If you think about it, every past recession, the Fed's printed us out by lowering rates, quantitative easing. But with inflation at, let's say, even if it comes down to 4%, they're not going to print us out. They can't, because it would send inflation soaring again. So it's a very tricky scenario, and I think the market is starting to be really nervous about that aspect. And that's the worry that I have, is that they're going to put themselves in this box by over tightening too quickly. By the time all of these rate hikes kind of are digested in the economy, then they're going to find out too late that they've sent us into a bad global recession. And then at that point, we're going to all look to them and say, oh, can you guys print? Oh, wait, we can't print money. because inflation is still elevated at 4%, let's say. So it's a really scary scenario where we could see, in my opinion, it's very likely we'll see a protracted, like a long-term bear market that could last for 5 to 10 years. And it just could be nasty. I mean, it's a scary scenario. I think you still got to think about gold as the kind of a safety play here. We'll talk about that obviously in a little while. So nothing's changed, unfortunately. In fact, the hawkishness of the Fed is exactly what Bitcoin doesn't need right now, and it's pushing it lower. So if I show the Bitcoin chart here, what we can see is that you've been hammering on this level over and over again. This is back in June, in late June, or excuse me, this was, June, in early July, in mid-July, and then over here in September. And look at what's happening on this candle today off the Fed. It looks like we're starting to break lower. Now, we will have a little support at the June low of 17,500, but if that gets broken, then there's not a lot of support until you get to like 13 to 12,000. And I think it's looking more and more like that is going to be the ultimate outcome here. For me, there's no question that it will exist. The question is, how long does it take to get regulation out there where institutions start to feel comfortable investing in it? So there's always going to be this need and this trust that Bitcoin, there's a run of 21 million. And so therefore, it's not the fiat currency that is the US dollar, is the yen or the euro or any of these other currencies that the governments can just print nonstop when they want to stimulate. And so I think you have to look at it like that. And you have enough big money, the Michael Saylors and a bunch of other players that have drawn enough attention to it. And then you have countries like El Salvador that have adopted it as kind of a currency there. I do think that it will survive, but it's going through its dot-com bear market, right? So if we think back to the dot-coms, you had the Amazons of the world. That stock went from basically 112 to about, I think it was about $6 or so. So a 95% drop. And it's very likely that we're going to see that on Bitcoin. The fact that people are saying, they're beginning to say, oh, it's not going to be in existence anymore. That's exactly what I want to start to hear, to believe that we're close to a bottom. I don't think we're at the bottom yet, but when you hear more and more people saying that, because by the way, they said that in 2018 as well, after the highs in 2017, it was 20,000, it went down to 3,500, and you had tons of people saying, oh, forget about it, it's old, it's done. And then what happens? It goes to 69,000. So you look for those contrarian indicators. And again, the belief is there's enough young people, especially, that understand the fiat currency issues out there. And they are into the digital age now, where they're not just looking at gold, but they're looking at these other currencies, essentially cryptos. So to me, it's not so much of a concern because, a digital currency is still a fiat currency in that the Fed can then just click a button, kind of like they do now, and probably just print another $1 trillion or €1 trillion or whatever. And so the allure to me for Bitcoin is that it's that digital gold. So gold is a great, awesome commodity. I own a fair amount of physical. I'm invested in it currently as an investment via the GLD. And I like it because of that aspect. It's kind of a safe haven aspect. And I think that Bitcoin is becoming more and more of that. So it's going to kind of separate itself. And then if you look at where Ethereum is and where some of these other cryptos are, they've got a big use case, right? They're being used for things, building platforms on top of platforms. And I think that's the key too, is I want to actually see Gary Gensler kind of come out with okay, these are securities. Okay, they're securities. That's fine. Make them do legitimate reporting, legitimate audits. I want to see that. That's transparency. That's a good thing. I'm not so concerned about the decentralization getting kind of taken away because they have a use case. And so to me, an Ethereum is almost like a Google or a Apple. And I think that's what it becomes, of more of a security, while Bitcoin is more the digitalized gold. And then you have the central bank currencies, which are just created to kind of do transactions back and forth. And the government obviously still has control of that.
What do you think going forward? Are we going to, you said potentially a bear market for five years or more. Is it time for people to exit the market? I mean, is it dangerous right now?
So, I'm never a proponent of after big drops exiting. It's, you want to wait for the bounce. You want to buy things that are on sale. So for me, if I'm looking at the S&P, and we can look at the S&P chart here, is that certainly it was a nasty sell-off. You could almost see the writing on the wall, and I'll show you how the charts kind of told us that we were likely going to see some downside. So if you take this low from June and you connect it to this secondary low, which is in kind of July, look at how it connects perfectly right through. So pivot low, pivot low, pivot low, and look how you broke down just before the Fed. So you had a break of that trend line. So what that tells me is that the market was going to likely head lower. The question is where to? Near term, I think we're probably headed back to the June lows, which is only about 150, 160 S&P points lower. So that is a big move, don't get me wrong, but that will be a big sticking point where you get a big bounce. I'm going to look to buy stocks into that level for a technical bounce. Now, I'm not going to hold them long term, but I'll hold them for a few weeks, get some nice bounces off of them in this environment. But I do think down the line, you are headed towards this pre-COVID high from February of 2020. That will be that target. I do think there's a chance by year end we get there on the charts of the S&P 500. And by the way, one other thing I'd mention here, a lot of people comparing Volcker, what went on in the 80s to what went on now. To me, what scares me the most about that is that when Volcker hiked rates, he went from like 12 to 18%, somewhere in that vicinity. And you could say, okay, that was a massive 6% move up in interest rates. But where were you starting from, right?
Yeah,
you were
exactly.
starting from 12 to 18. And so it was basically like a 50% move. If you look at where the US interest rates were, they were at 0. And you've hiked them now from 0 to 3.15. And you're talking about, the percentage and therefore the impact on the economy is going to be exponentially greater than during Volcker's rule. And I think, again, if Jerome Powell's listening, be really careful, because you are opening a can of worms here that it's not going to be easy to get out of.
Does the government come into play at all? Because don't you have midterms coming up very soon?
Yeah, so that definitely comes into play a little bit. I know that here in the US, they passed some new legislation, which was stimulative. So needless to say, that's probably not great for the inflation side of things, for the spending. But I think that midterms, you likely will see some bounce going into the midterms. If you think about it, people are not going to be happy voting for the Democrats that are in power if the market goes straight all the way down. Let's say we're down another 10 or 20% going into the midterms. That's not going to fly. So that's why I think right now we're far enough away, you're getting some downside. But then right around the midterms, I'd say by mid-October, definitely look for a bounce into early November. And then we'll have to see into year end. A lot's going to be determined on that, the CPI data, the consumer price indexes, where do those come out? And does it shift the market's view of what the Fed has said in terms of, we got to raise rates a lot more. If all of a sudden CPI starts coming in and the economic, let's say the jobs numbers start to decline, get worse and worse, then you'll see a different tune from the market. And the market will actually rally on that, which is kind of crazy. A weaker economic picture and the market would actually rally.